All right, let's dig into CF Industries' latest earnings report. They dropped their Q4 numbers, and wow, the market absolutely loved it. The stock jumped almost 4% on some pretty big volume. So what on earth was in that report that got everybody so fired up? Let's get into it. Okay, it all kicks off with this number right here. Look, CF didn't just beat earnings estimates, they kind of blew them out of the water. Wall Street was modeling what, about $2.47 a share? Well, CF came in at $3.06. That is a huge 59-cent beat.
And it wasn't just the bottom line either. The top line, the revenue, was just as strong. Analysts were looking for something like $1.78 billion. Nope. CFE posted over $1.87 billion. That's a beat of $92 million. So let's pull back for a second and see the whole picture.
First things first, let's just unpack the headline numbers that really set the tone right out of the gate. I mean, just look at how consistent this is. It wasn't just one thing that looked good. You've got your official GAAP earnings, the adjusted numbers everyone really cares about, and revenue, beat, beat, beat. Straight across the board. You know, a clean sweep like that just tells you the business is firing on all cylinders. And hey, if you want a real sign of how confident management is feeling, look no further than this number. They spent over $1.3 billion buying back their own stock just last year. They literally took 10% of their own shares off the market. That is management putting its money where its mouth is, loud and clear. It's a huge signal they think the stock is cheap. So how does all this fit into the bigger picture? Well, management is telling what they're calling a two-engine story. One engine powering today, and the other one fueling up for tomorrow.
It's actually pretty simple when you break it down. On one side, you have their main business, the core nitrogen franchise. Think of it as a predictable, cash-gushing machine. And then on the other side, you've got their new clean energy platform. That's the high-growth engine for the future. And you guessed it, the first one is paying for the second.
So let's talk about that core business for a sec. Its financial power is just immense. We're talking almost $1.8 billion in free cash flow last year. That is the bedrock of this company, right? It's all built on their cost advantage here in North America and what management kept calling constructive global markets. And here's where all that cash is going. The clean energy platform, you guys, this isn't just some bullet point on a PowerPoint anymore. Projects are actually getting the green light. Their carbon capture stuff is online and working. And this is crucial, they are making money from tax credits and selling their low-carbon products for more. The big takeaway here is this is becoming a real source of earnings, not just some feel-good ESG thing. But, you know, it wasn't all sunshine and rainbows. We got to look ahead. We have to talk about the company's guidance and the one big operational issue that analysts really hammered on during the Q&A part of the call.
So with all this great momentum, what's the one dark cloud on the horizon that has investors a little bit worried?
It's this, a major, totally unplanned outage at their Yazoo City facility down in Mississippi. That plant is completely offline, and they don't expect it to be back up and running until late in the fourth quarter, at the earliest. That's a direct hit to their production for the whole year. So what does that actually mean for the bottom line? Well, management put a number on it, a potential hit to EBITDA of around $200 million. Let me tell you, that is not a small number. That gets your attention. But, and this is the key piece of info that totally calmed the market down, management pointed out they have business interruption insurance, and they expect that insurance to cover most, if not all of that $200 million hit. For investors on the call, hearing that was just a massive sigh of relief. Okay, so let's put it all together. You've got this huge earnings beat, you've got a really clear two-engine strategy, and you've got a major problem that, well, seems to be under control. It's time for our take.
You know, the whole debate on CF really just boils down to this. The bulls, they see a tight nitrogen market, a company that's a proven winner at returning cash, and this huge growth potential from clean energy, all while that Yazoo problem is basically covered. The bears, on the other hand, they're worried about delays in getting that plant back online, the high cost of new projects, and the simple fact that fertilizer prices can be, super volatile.
So our call is outperform. We think the strength of that core business, combined with the real, actual progress they're making in clean energy, more than makes up for the short-term and likely insured risk from Yazoo City. Plus, the fundamental market for their products looks really strong heading into next year. And look, this isn't just wishful thinking. If you look at the last year, CF has already been a winner. It's outperformed both the S&P 500 and the other agriculture stocks. We believe the stuff we've been talking about is going to keep that trend going. All right, finally, let's turn all this analysis into an actual idea. What's the outrageous but totally plausible trade that comes out of this earnings call? Here's our trade idea. Start a long position, and we're setting a price target of $125. Now, the two key things you got to watch for are simple. First, any news at all that the Yazoo City restart is happening ahead of schedule. And second, another big contract, an offtake agreement, for their low-carbon ammonia. That would be more proof that the clean energy engine is really revving up.
So CF Industries seems to be navigating this big transition from a powerful traditional business into a true two-engine growth story. If they can get that plant restarted and keep proving their clean energy idea works, the market is probably going to keep rewarding them. This is not financial advice.